In this example, I want to go through how to calculate the weighted average cost of capital in Chapter 11. The weighted average cost of capital has been building up through previous chapters as we looked at how to calculate the yield to maturity on debt, how to look at the capital asset pricing model, where we had the risk-free rate plus beta times the difference between the market return and the risk-free rate. And what we need to do with weighted average cost of capital is we're going to take the weight of the equity and the weight of the debt and add those two together and find out what is the appropriate opportunity cost for our investors. And I'm going to walk through the example on page 348 with estimating PepsiCo cost of capital for the restaurants. Now, we've been told that the rate of return for investors on the yield to maturity for their debt is about 8.93%. But corporations get a benefit from deducting interest expense. It helps lower their tax liability. So we need to look at the after-tax cost of debt. So we need to take the pre-cost of debt multiplied by 1 minus the tax rate. And in this case, if we look at that, we have equals 1 minus, and the tax rate in this example was 0.38. So that's where they come up with the 0.62 in the textbook. So 38% tax rate. Next, what we're going to do is we're going to say equals the 0.0893 or 0893 times that 0.62. So this is what's known as the after-tax cost of debt. So about 5.54% if we look on that on page 348. Next, we need to calculate the required return on the equity, and that's the CAPM model. And the CAPM model says I need to take the risk-free rate, in this example, typically like a treasury bill, a treasury bond, probably a treasury bond here in this example, 7.28%, plus, and then the beta times, so we do shift and 9, we need to do the expected market return minus that risk-free rate. So I have it in a formula now, and I close out parentheses, shift 0. And if we hit enter there, I'll give us a little bit of an error there, so I'd have to go back and look at my formula. But if we did that, what we would end up with in this case is 0.1219. I'm just going to type it in for now, and you can kind of work through the formula later. But this is the required return from the investment perspective of the equity. This is the required return from the debt, the after-tax cost of debt. Well, this is not too exact, but let's just say that the market value of the debt was $30 million for investors, and the market value is $70 million for the equity. If you owned all the shares times whatever the price was of PepsiCo, and that was $70 million. So the total value of the two together, the 30 plus the 70, would be equal to $100 million. So to find that weight, I'm going to take equals 30 million divided by 100 to give me 0.30. And I kept the example simple to kind of just show that 30% that they have matching up in the textbook. Again, if I took equals 70 divided by 100, and we get 0.70. Well, the next thing we need to do is we need to take the weights times the after-tax cost of debt and the weight of equity times the required return on equity. So I'm going to do that right here. First, the weight of debt times the after-tax cost of debt. So I'm going to say equals the 0.3, 30% weighted debt, times that 0.05536, and hit enter. And I get a little over 1% there, about 1.6%. We're going to do it for the weight of the, I got to change my, this is equity right here, so just make a little correction. There we go. Weight of the equity times the capital asset pricing model. So again, we have here the weight of the equity was 0.7. Multiply that by the required return on the equity, and we get 0.0853 or 8.53%. Last thing we need to do is we need to add these two things together. So I'm going to do that right here and show that. So I'm going to say equals 1.6 plus the 0.08533. If I hit enter, over here it tells me that my weighted average cost of capital is 10.194%. And if we kind of check to the textbook, they just rounded up and it had 10.20%. So this chapter is going to take a little bit of reading to go through and kind of look at the different examples, but this is the basic method for calculating the weighted average cost of capital. It really now has gotten to a point where we have something appropriate to use for a discount rate when discounting projects. Before, we've just kind of said, well, the rate is this, and we really don't know where that rate comes from. But now we do have something logical where we can say that we are meeting the investor's opportunity cost based on his or her required return on the debt and equity. In this example, we just used debt and equity, but as you read the chapter, you'll also notice we can include preferred stock, whatever the required return for preferred stock would be, multiplied by whatever that weighted return would be. And typically for textbook examples, the equity, we want to look at the actual market value. Always important to go to market value. But for the debt, the book value and market value are going to be very close most of the time. So the book value can be a good approximation. And that gives you a good example of how to calculate the weighted average cost of capital.